Okay, so in our last video, video number 2, we left off talking about how first we journalize, and here we only see one transaction being journalized, but if this was to be done manually, you first complete all the journal entries for the time period, and then you start posting into the GL accounts, okay? So I left off talking about the cash account, and as you can see, the journal entry was 2,400 into the cash account. In this case, the cash account had a previous balance or various entries, so you can see the previous entries here. This is the 2,400, which was journalized on December 1, posted into the account here, and this is the net balance, and you can see here 25,000 minus 2,000 minus 2,400 does not equal 3,500. So obviously there were various transactions here in between that are not being shown because these balances here would be the net of the plus and minuses that we see over here on this side. Okay, so that's for the cash account, as I said. So that's first we journalize, then we post. Okay, in my example, I will show you the GL accounts in T format because it's much easier for us to see and for us to analyze. So here's an example of how we would see how I'm going to show you the here's an example of how I represent each GL account, general ledger account, as you can see up here, cash and so forth. It's in T format, and that I do just so that it's easier for us to see and for us to analyze the entries. But the official way a general ledger account will look is more like this, how it's shown in the book. Okay, so first we journalize all the entries. Once we're done journalizing, we'll go ahead and we'll post it into each of the individual accounts, and then comes the third step. The third step, involves creating the unadjusted trial balance. And I'll explain why it's called unadjusted in the next step. So this is a very simple step. It consists of taking all your GL accounts from the general ledger and placing their balances in a sheet like this, and the unadjusted trial balance is presented in the same order as it's presented in the final financial reports, starting by the balance sheet. So you can see cash tends to be the first account presented in the balance sheet. So we'll start off with assets. We'll go ahead with the liabilities in the balance sheet, and then the equity accounts in the balance sheet, and then we'll go with revenues and expenses. And we put all the debit balances here and all the credit balances here, and they should match. If they don't match, then you have a problem and you have to go back and try to fix it. These days with the automated systems, you probably are going to find the problem beforehand, but manually you may overlook something, a transposition, or you wrote down a number wrong, and so this is an opportunity for you to catch that mistake. If they don't balance, then you know there was an error where you entered a debit and a credit that didn't balance, and so you have to go back and look for it. Okay, and this is the unadjusted trial balance. So most of these transactions were initiated, there was a transaction that initiated this, and so we need to do these entries, right? But there's a lot of entries that occur due to the passage of time or usage of a product, or so at the end of the month we have to start putting those entries in, and those are what are called the adjusting entries. So once we're done with the trial balance, we need to start posting the adjusting entries. There's 4 basic type of adjusting entries that we have to do. Prepaid expenses, unearned revenues, accrued revenues, and accrued expenses. Okay, so these videos are just supplements to your material in the book. and your PowerPoint slides and all other materials. So if we go to the PowerPoint slide and we look at what definition they have for prepaid expenses, they say that prepaid expenses are the advance payments of future expenses and are recorded as assets when cash is paid. Unearned revenues are the advance receipts of future revenues and are recorded as liabilities when cash is received. And accrued revenues are unrecorded revenues that have been earned and for which cash has yet to be received. Accrued expenses are unrecorded expenses that have been incurred and for which cash has yet to be paid. Okay, so those are the formal definition. Let's see if I find the the definition of adjusting entry here. Well, I don't have it, but those are the individual definitions of each of those types of accounts. So let me just give you examples. So let's say, for example, we prepaid 1 month of rent in advance. So we prepaid 2015 in rent on December of 2014. Okay, and we prepaid the full year. Each month is going to cost us $1,000. So our cash is going to go down, right? So we have cash. It's going to go down because we paid $12,000 in advance, right? And cash goes down with a creditor. Have we incurred an expense? No, we have not incurred an expense until we use the rent, right? So we have another asset, prepaid rent. So all we have done is exchange one asset for another. Cash for prepaid rent, the right to use rent for 12 months. What's going to happen at the end of January when we've used 1 month of rent? Well, we've incurred 1 month of expense, right? So does this prepaid have the same value of $12,000? No, we've used up 1 month of rent. So we need to bring this prepaid rent down to its proper value. It lost $1,000 in value, right? So we will credit it for $1,000, and the net value will be the combination of these, right? 12 minus 1,000 is going to have a $1,000 net value, and this is going to be a credit. So let's go ahead and indent that a little bit. That's the proper way to journalize something. The debits, the credits go slightly indented to the right from the credits from the debits. Okay. And so we're going to recognize expense. 1 month's rent expense is going to be rent expense, right? Rent expense, and we're going to recognize $1,000. Okay. So what's key about the adjusting entries, and I don't know if it explains it in the book, but these adjusting entries, the initial transaction comes with some sort of document that's going to alert you to make the entry. So here, for example, what better alert than $12,000 of cash going out? So you'll be able to see that either in the bank statement, or you'll be able to see that in some sort of purchase order or so forth. So the initial entry usually comes with some sort of document that alerts you to record, to journalize this entry, right? But the subsequent entries, the adjusting entries, are recorded due to the passage of time or usage, right? And there's no document that comes with that. So you must remind yourself to post those entries. Again, these days with the automated systems, you can automatically tell the system, I want you to put a recurring rent expense, offset it with prepaid rent every month for the next 12 months, or at least tell the system to remind you to do it. So that would be an adjusting entry, and that's an example of a prepaid expense. Another adjusting entry, let's say unearned revenues. Okay, so let's say you are a service company, and you're going to perform some services. Let's say you cut lawns. Okay, so and you have a customer that was nice enough to pay you 3 months in advance. Have you earned this revenue? No, in the revenue recognition concept says that revenue is recorded and is recognized when it is earned, and if it is reasonably certain that you're going to collect on it. So we haven't earned anything as a service company, right? We've accepted the cash, but we have not performed the service. So now we have to cut grass for the next 3 months for this company, or maintain their lawn, or whatever service we're going to perform. So do we have we earned anything? No. Have we received cash? Yes. So we received cash, and let's say that every month we're going to charge $1,000. So we received cash of $3,000. Sorry, we received cash in advance of $3,000, and now we've created a liability, right? This is a liability because now we owe this company, we owe them 3 months of service, which they paid in advance. So that for us is a liability. And so we have a liability of $3,000 of unearned rent revenue. So let's say at the end of the month, our employees went out there and they cut their grass and so forth and so on, and so we earned 1 month of lawn maintenance. So we're going to recognize that now as revenue, right? So let's say this occurred January 1, and on January 31 we checked with our head lawn maintenance guy, and he said yes, we went out and we maintained their lawn this month. So we're going to go ahead and we're going to go ahead and book the revenue for 1 month, and we're going to then, revenue has a, you see, even I get confused every once in a while. Revenue has a credit balance, right? And we're going to go ahead and we're going to lower our liability because we fulfilled 1 month's worth of work, unearned revenue. So that's an adjusting entry. I gave you an example of 2 adjusting entries. Go to your book and learn more examples if you need to, and practice the exercises. That's very important. So you have to now start booking adjusting entries at the end of the month. Okay, these are entries that, they don't come with any reminders. At the end of the month, you have to remind yourself to update these accounts. These entries update accounts. And here they have highlighted for us in this example, various accounts which were updated through adjusting entries. As prepaid insurance, that's very similar to the example that I gave you of prepaid rent. Depreciation is another thing that's an adjusting entry. As the equipment gets older, you have to depreciate it and expense it, right? Do they have an unearned revenue? I guess I don't know, maybe I don't see unearned revenue here, but unearned rent, for example, here they went and they collected it. So there's various adjusting entries that in this example was posted, and now we are doing the adjusted trial balance. And again, very similar to the regular unadjusted trial balance, the adjusted trial balance, the main purpose is to make sure that these match. And if they match, you're okay. Now that doesn't necessarily mean that your accounting books are perfect. You could have entered a debit and a credit that matched, but that were wrong. Let's say, for example, instead of entering 2065, I entered 2056, and I did it on both sides. I did it wrong on both sides, so it's still gonna match. But at least this tells you that technically speaking, from a debit and credit standpoint, you have posted things correctly on both sides. I see I'm running out of time, so I don't want to cut off abruptly, so I'm going to start in the next